But what I see is one, just from a bare bones perspective, is a collection rate. How well are you collecting on what you are billing out, and then determining, are we collecting based on our insurance contractual rate? Are we collecting based on our write-off percentages for any potential bad debt, for self-pay, or for denials or pre-authorization issues, other things that are impacting our collections. And so one of the things I really see organizations not always do consistently is really monitor that denial rate and ensure that they understand, why did we not get paid what we thought we would get paid for this service? Was it something related to our coding, to the services we provided? When it comes to that denial rate, is understanding what it is.
Welcome to Medical Money Matters, the podcast where you can find experts, answers, and resources so that you can achieve mastery over the financial and business aspects of your practice.
Hello, everyone, and welcome to Medical Money Matters. I am joined today by Tony Andrade, who first and foremost, I am fortunate to call a friend. Tony is a partner at Moss Adams, LLP, where he serves as the national practice leader for health plans, risk-bearing organizations, and insurance companies. Their company has now merged with Baker Tilly. That's fairly recent news. And for more than 30 years, Tony has worked as an audit partner, and he focuses on business consulting for healthcare organizations, including insurance companies, health plans, hospitals, and medical groups. He served as the president of Oregon HFMA a couple of years ago. And as an interesting note, he is relatively fluent in Portuguese, and he has a collection of over 2,000 vinyl records, which has led him to become a host on a music podcast about punk and post-punk music of the early 80s. And that podcast, for all of you who are now wondering, because you want to go tune in, is called Deep Dives and Deep Cuts. So, Tony, thank you. Thanks for joining me today. It's great to have you.
Thank you so much, Jill. It's an honor to be here.
Awesome. Well, we will just dive right in. I love the Portuguese and the vinyl. We're going to have to get back to that. But we'll jump in on our financial questions first and foremost. I'm curious, as you look at a lot of medical groups and you look at a lot of financials, as you're working with clients, what are the most overlooked financial indicators that medical group leaders should really monitor regularly to ensure their long-term sustainability and performance?
Sure. One thing I'll mention is the majority of my clients in the medical group and the hospital space are in the Northwest. So Oregon and Washington really is my footprint. I work with a number of organizations across the country, but certainly looking at the key metrics for physician practices, it's really based on what I've seen in the Northwest. Our company works with a number of organizations across the country, and we share information and that sort of thing. But it's pretty common when we look at our physician practices and what we think they should really focus on. And some of the things from my perspective, which is always the financial side, certainly there's also the operational and the quality aspects to consider. But what I'm really going to focus on is really the financial side, and we can certainly discuss some of the others. But what I see is one, just from a bare bones perspective, is a collection rate. How well are you collecting on what you are billing out, and then determining, are we collecting based on our insurance contractual rate? Are we collecting based on our write-off percentages for any potential bad debt, for self-pay, or for denials or pre-authorization issues, other things that are impacting our collections? And so one of the things I really see organizations not always do consistently is really monitor that denial rate and ensure that they understand, why did we not get paid what we thought we would get paid for this service? Was it something related to our coding, to the services we provided? When it comes to that denial rate, is understanding what it is. A lot of times I just see, it get coded directly to a denial code, rather than really understanding if it was a timely filing issue or if there's something else involved. So from really kind of a financial or revenue cycle perspective, that's one of the things that I think is really important to understand. From a more financial aspect, there is just the estimation of your accounts receivable. at
Mhm.
the end of the year, how much of that amount do you really feel you're going to collect? A lot of smaller medical practices, especially, don't really monitor that number and try to determine how much they're going to collect. I think it's important because you want to see, did we actually collect what we think we're going to? And if we didn't, why was that? I think
Yeah.
that's a really important look back analysis to do, because maybe there is something you can do better to ensure you're collecting what you should be, or maybe it truly is insurance contractual rates and other factors that you should be aware of and you should be communicating to your physician leadership group.
Yeah.
Other things from my financial perspective is also understanding your any debt covenants that you
Mhm.
have, whether
Mhm.
it's with banks, with other lenders, to ensure that you're meeting those covenants, looking at that quarterly, at least throughout the year, so you know if you'll be out of compliance at your end. And you're talking to those lenders timely to ensure there's no surprises. And then
Yeah.
finally, looking at the debt to equity calculation to see how leveraged are you. If you have a high debt to equity ratio, it means you have excessively high debt, especially when you compare that to the industry benchmark. Generally, I want no more than 2 to 1 as a ratio, meaning $2 of debt for every $1 of equity within
Mhm.
the medical group. To me, that is probably at the highest I want to see when it comes to a debt to equity calculation. And sometimes practices get out of sorts or out of compliance from that perspective, where they're much higher than they really need to be, which means they can't borrow, they can't invest in their future. They're really hamstrung to pay off their existing debt.
Yeah. Yeah. Those are great metrics. I thank you for that. It takes me back on the denials. One of the statistics I heard recently, which kind of made me go, was that 62% of denials are never followed up. And that number struck me as incredibly high, but something I think for our audience to think about. And to your point of looking at that, like, why didn't we get paid what we expected to? And so I would say denials and underpayments too, because a lot of times the
Right.
system will automatically post a payment, but it might not be according to your contract. And so, yeah, there's that mismatch too. But
And
I,
as you know, I mean, the last year, 2 years, Medicare Advantage, I think when you look at those denial rates, we've seen probably a more disproportionate denial rate with certain in Medicare Advantage plans than we have with other insurers.
Yeah, yeah. No, that's a great point as well. The denials are up. We go into a lot of groups, as you might imagine, when we're doing accounts receivable cleanup work, and we find that somewhere someone along the way told a biller, "Oh, you don't have to worry about following up with that," or somebody was just overwhelmed and didn't have the time to do the work, and it's to your point, it's real money sitting there,
Yeah.
and yeah, critical to get the follow up and to make
It's
sure.
especially during the pandemic. I feel like there was turnover. Sometimes there were people working remotely where the cross training didn't happen exactly how we would have done it historically. And
Yeah,
so, like you're saying, you might have new individuals in certain positions who are told, um, very quickly, do things
right.
this way, and they
Yeah.
believe that's how it should always be done. And now that you have the time to look back, you realize, wait, this isn't how we would have done it.
They haven't done the training. So, um, they're, it's, I think imperative too, as you said in your first KPI for the physicians to look at their accounts receivable. And I think a lot of times, physician owners don't understand that those are all presented as, gross numbers. Those are the sum total of your gross charges that are out, which, no one expects to get paid the full amount of that. So that's I frequently have been in meetings with physicians where they look at that and say, "Oh, there's 5 million in accounts receivable, and so we can expect that money to come in," when in actuality it's probably more like 3. Depending on where their conversion factors are set and all of that.
Mhm.
Yeah, so that's fantastic. I love to see groups that are using metrics. So it's great when they are. So you have in your career supported a lot of clients through numerous audits and regulatory shifts. And I'm curious what common gaps you see in how healthcare organizations prepare for those processes and how they might tighten things up.
Sure. Number one is insufficient internal controls. And to me, that is by far what I see consistently across the board,
Mm.
especially an organization going through their first audit or really kind of looking at having somebody come in and look at the processes, looking at and auditing their numbers, is looking at those internal controls and realizing, hey, we've got one person who really is responsible for a lot of these things. They receive the bank statements, they reconcile the bank statements. We generally want segregation of duties in a lot of these areas. We don't want the person who has access to cash to also have access to the bank statements. Generally, that's where you get potential fraud, is when somebody can control the different areas of how cash gets recorded and how cash gets processed. Years ago, you used to see a lot more cash coming through the clinics. Now it's a lot more of the wire transfers, credit card payments by the patients. So it's a much different way of paying. So you have, what I've seen is more inappropriate wire transfers,
Yes.
where we don't, you've got folks in management where maybe one person's in charge of certain areas, and they have the ability to wire money from one bank account to their own.
Yes.
We've seen some cases where the name of the company it's wired to has a very similar name to the medical group, because the fraudster, if you will, created another company name at the bank, which you basically can create any name you want to at the bank, and then transfers the money over. And nobody's watching for unusual wire transfers or any of that sort of thing. Other things we've seen is there could be some vendor, maybe there's a construction project going on. We've had this circumstance happen a couple of times, where somebody will call the accounts payable clerk and say, oh, I'm with this construction company. We have a new wire account that we need you to wire the money to. And it's somebody committing fraud. They're just trying to get money transferred and wired into their own personal account. And if you don't have good internal controls to have double checks before you allow a wire account or wire transfer account to be changed, then they go ahead and change it. Nobody's looked, and now money has been transferred into a fraudulent account.
Yeah.
So for me, the insufficient internal controls is my number one area that most organizations are surprised that we come in and we'll say, there's a lot of opportunity here. And from my perspective, I also tell management, this isn't just because we think you're committing fraud, because most are not.
Right.
It's
right.
mostly to be protecting you so that nobody could ever accuse you of this, because there's sufficient controls to ensure that doesn't happen. So I primarily looked at or discussed bank statements or bank access controls. There's other areas related to, a wire transfer payment coming in and somehow it gets transferred to a different account, whether it's something with the revenue cycle. Obviously, you've got some areas related to revenue cycle, like considerations of upcoding and some other areas, but we're really focusing on the financial statement side and areas. And like I said, really cash controls tends to be number one. Fictitious vendors and accounts payable is another one that can be a significant area. And then accounts receivable, just because there's so much cash that's flowing back and forth electronically, that you have to make sure you're monitoring how those accounts are handled and ensure that those are not inappropriately being
Diverted
being diverted, being changed. What we'll see sometimes is fictitious credit balances, and then refunds get issued, and they get issued to somebody outside of who it really, if it was a refund, should have been issued to.
Yeah. That's a good one, actually. And there are so many ways people can steal money from medical groups. So thank you for bringing in the internal controls conversation. I just last week had a conversation with one of our clients who recently found they've been embezzled. This is our third client this year, which makes me sad. So I think either we're talking to more groups or embezzlement is on the rise. But that individual, their bookkeeper had actually been, the longtime administrator had left. So they had a new leader in place. And so things were a little squishy. And the bookkeeper took advantage of that and began sending ACH payments to herself in, a few $1,000s a day. So she was really taking quite a bit of money from the practice.
Yeah, I think
nobody was watching. Yeah.
Physicians typically aren't accountants, and knowing where the line is of like, I've got this administrator, they've been here for 10 years. I trust them, but I always say you can't, trust but verify sort of thing where, it's a best practice every few years to have somebody come in, kick the tires if you don't have an annual audit process.
Right.
It's not accusing somebody of something. It's just saying, hey, we just want to make sure it's being done correctly. It's for your protection. It's for ours.
Yeah.
especially in a small shop where you just don't have a lot of individuals. And so
Mhm.
you could have somebody who does, wears different hats, does different things, and could have access and ability to do something.
Yeah.
I think you've seen this. I've seen it in a number of cases over the years where the office manager is able to do something. And it could have been somebody that's been around 5 to 10 years. All of a sudden, now there's some either family obligation, there's a medical issue. Generally, there is actually some, I guess if you want to call it a purpose or a reason why they're
Mhm.
taking the money.
Yeah.
It's not just from fraud from day one. It's more like, oh, I've got this need and now I'm substantiating why I need
Yep.
to do this.
Yep.
But we
Yep.
see that. I had one a few years ago where they decided not to move forward and have us look at things, even though they've had somebody for 10 years, but there was enough indications that something just didn't seem right, but half the physicians did not want to upset the office manager
Mm.
by having somebody come in. So
Yeah.
it's a tough, and I can understand it's everybody knows each other really well, but you also have to, at the end of the day, you've got a medical group to run.
Yeah.
You've got a practice to run to make sure physicians are being paid appropriately, that your staff are being paid appropriately, and ensuring that the internal controls are there is that much more
Yeah.
important.
Well, it is great business practice, to your point, to have an external entity of some kind come in and look at your processes, your internal controls, all of that. That's good business. It's
Yeah.
nothing more. And I love that you called out. I frequently say that too. This is really for the employees' protection so that no one can, assume or accuse them of embezzling money. So,
And there are financial audits, which I do, which usually the banks or a third party wants security and
yeah.
comfort that the numbers are correct. But you can also do an internal audit sort of thing where you have
Mhm.
folks really come in and look at very specific components, whether it's cash controls, etc. So there's
Yeah.
different ways to structure this
That's
if you're
great.
concerned.
That's a great segue for us to wander into a little bit of like the different types of audits that there are. I hear physicians use the word audit a lot and in different contexts. And so can you just run through the basic types, like the different ones that you would get hired to come in and do and
Yeah.
what that means?
Exactly. The one I generally that I get hired for is what's called a financial statement audit. It's at the end of the year. Here's our balance sheet. Here's how much cash we have. Here's how much accounts receivable. Um, what's called fixed assets or your equipment and any property you might own, and then your liabilities, accounts payable, any payroll that was owed at the end of the year, vacation, and then debt. If you have lines of credit, if you have borrowings, how much do you owe at the end of the year? And then basically the difference between those two numbers, your assets minus your liabilities, is the equity or the physician's ownership at the end of the day. So we do a balance sheet and income statement audit, and that information typically goes to your bank or goes to a third party who really wants to ensure that you have as much assets as you say you have.
Yep.
That's generally considered to be kind of the highest level, if you will, and honestly the most costly is a
Mhm.
financial statement audit. Sometimes you might hear the bank say they'll take a review, and
Mhm.
that's the next level down from an audit. It's really just putting the numbers together, having the external accountants ask some basic questions if things don't make sense. But if I'm doing a review, I'm not digging in like I will on an audit where I pull samples, where I'm verifying balances with the bank, or I'm looking at detail for accounts receivable. It's more of just doing some analysis if things make sense.
Yeah.
And then finally, there's a compilation level, which is really just taking the clinic's numbers and putting them into a financial statement. It's basically if you needed help in creating a financial statement, that's a compilation.
Mhm.
Generally, banks want an audit. Sometimes it's a review if they don't have a lot of debt that they've loaned out to that group. So that's really the world that I live in. And then I talk a little bit about this, which is the internal audit, really looking at those internal control processes. So you can do that at a smaller scale, just focus in one area. And that's something that certainly can be done. And I know, Jill, with kind of the world outside of the financial side, you hear of a claims audit or
Yeah.
a compliance audit,
Yeah.
regulatory, and then even a government audit if you're getting audited by CMS or somebody else. So there's a whole host of different types of audits that we
Yeah.
can all get involved with. But I'm really in the financial world. I know, Jill, you get more involved in some of the other types of
A little
audits.
more in yeah, a little more in the other ones too. And then I will say as a former clinic administrator, sometimes I would do an audit of something like do our schedules, how many patients are we scheduling per day and are our schedulers utilizing the right templates or In the instances we were talking earlier about payments coming in prior to the time when there was software to do this, because I'm old, I would go and manually check, like, well, we have a contract with this insurance company to pay us this much per RVU, and are they actually paying that much? So yeah, so there's a lot of different forms of audits, and thank you for just calling out all of the different ones. Like I say, I hear those terms being, sort of thrown out in board meetings, and I always want to stop and clarify, like the
financial
former
statement
accountant.
audit.
Yeah.
The financial statement audit is required to be signed by what's called an independent CPA.
Mm-hmm.
So somebody that's not part of the group, that's external, that you've hired to be an independent, that has no other connection to that group, and signs off on that report. And I always say when I sign the report, that's my house. So if I'm wrong on these numbers substantially, the bank could very well sue me and say, hey, you told us this group has this much, and they really don't.
Yeah.
And then, basically that's my house on the line. So I take that pretty seriously.
Yeah. Yeah. No, that's a good way to put it too. And it's, I thank you for calling out the role of the independent CPA and how important that is really for the banks to make certain that, all the debt covenants are going to be followed. So that's a great segue for us to talk about what you see that medical groups might be able to do differently to improve their financial compliance with debt covenants. And where do you see groups, like you said earlier, sometimes they get a little top heavy with debt on the debt to equity covenant. What else do you see out there, and how else can groups improve?
Yeah, what I'll start off with as a recommendation is putting together a scorecard, very simply, of that you monitor on a quarterly basis or even monthly if you feel like you need to, that really has, here's our compliance requirements with the bank or other key metrics. And then I love color coding. So it's a green, yellow, red as to where are we at this quarter. Red meaning we're out of compliance, green meaning we're in compliance, and yellow means we are in compliance, but we're really close to falling into the red category. So to me, if you have a one-page analysis of where are we at, here's things maybe we agreed to at the beginning of the year as a physician group that's important to us, and what our key numbers are. And then where are we at each quarter, if not monthly? I say quarterly is probably better. Monthly sometimes can be a little overdone. And then quarterly really says, here's where we're at. And you can, as a physician, quickly scan it. You can see where the red is and understand, why are we out of compliance? What is going on? Is it a revenue factor? Is it our liabilities are continuing to be higher and our expenses tend to be higher? So to me, I do like that because it doesn't require the physician to look at every individual number. It's more understanding, like green, yellow, red, for all of us, especially being visually.
That's okay.
Visually
oriented.
Visually oriented,
Yeah.
yes. Especially being visually oriented, it's helpful for me, and I know for a number of others, to really see that color coding and give you some senses. Where should we be focusing on this next quarter, and what can we do to improve things? So for me, regular monitoring and reporting is really, it sounds obvious, but I've seen it so many times. We get to year end, and then that group is surprised that they're now out of compliance with one of their covenants.
Yeah.
And that's what I say, just monitor it quarterly.
Yeah.
Know where you're at, understand where you're at, have those conversations with the bank. Generally, banks are not looking to own medical groups. So, right. So if they want to work with you, even though they might be a little difficult at times, ultimately they do want to work with you. And so at least laying the groundwork, coming up with a game plan or a turnaround plan or an improvement plan is very important. Generally, if you surprise them, a few months after you're in and say, oh, I'm sorry, we're out of compliance. Now, all of a sudden, you've got to pay for some sort of waiver or some process to get you back in the good graces. And I would say it's just better to be upfront and to know that ahead of time, especially if you're in management and you're talking to your physician group, that they know ahead of time that there are some issues here. Nobody likes surprises. I always think, even if it's bad news, get that out there earlier, come up with a plan to improve what has happened versus it's 2 months later. What are we going to do now? We can't really do anything. The year end has passed.
Yeah, that's great advice. And I would agree with your assertion that the bankers don't want to own a medical. They don't want to own whatever collateral you've put up for this loan.
Exactly.
That's not the business they're in. They really want to loan you the money and have it all work. And I like, thinking about it like a little preventive medicine. It's manage your debt covenants and make certain, like you say, that you're monitoring those. And if you're coming close to being out of compliance, getting on top of it and also communicating with the banker. In general, I think if they hear from you before they have to reach out to you, that's a good thing too. That's
It should be responsibilities of your management team, right? That's why,
yeah.
physicians can practice medicine, and if you've got a management team there that's watching these ratios, watching these relationships. I mean,
Yeah.
that's hopefully there's good communication
Yeah.
and processes involved.
Yeah, absolutely. That's fantastic. Well, let's think about some other best practices that you've seen successful groups implement. I keep hearing from people about, the margins are getting thinner and thinner. So, as you see groups looking to maintain profitability in a tightening reimbursement environment, what do you see groups doing out there successfully?
I feel like I'm going to make a couple of statements and they probably will seem somewhat obvious, but that is what I'm seeing. One has to do with just looking at your revenue stream is what are we providing services for? Are there areas where we can expand and provide other services? Because maybe you've got a very Medicare heavy population for the services you're providing. And, is there something that can extend to the commercial market or to a younger market that can really make that a more robust payer mix or
Hmm.
patient source? Because what I see is if you're relying too much on one payer, that can have some dramatic effects. So obviously now we're discussing what could happen with Medicaid
Yep.
in the next year in the Northwest, and if there's some significant cuts there, that certainly will impact that payer mix. And obviously you try to manage your payer mix to some degree to not have too much of one or the other. But
Yeah.
we do still see some practices that are not monitoring that very well and
Yeah.
ensuring that you've got a good payer mix and also looking at what services should we be providing. One of the things I've seen, especially since the post-pandemic, from I'd say the last 2 years, is looking at where are you providing services. Things made sense of where you had a clinic location, 5 years ago and
Hmm.
before. We're now seeing different traffic patterns, right? We're
Yeah.
seeing downtown, I'm in Portland, so downtown Portland has a different travel pattern, if you will, than
Yeah.
it did 5 years ago. So
Absolutely.
people will comment on that, where I've seen some practices either move or close their downtown practice because they've chosen that the outskirts is a more robust peer mix and they have a more consistent patients that go to their appointments, and it tends to be harder in certain areas than it was 5 years ago. And as
Yeah.
a practice, that you've got to look at those trends, especially in the last 2 years.
Yeah. Thank you for calling out the payer mix question. I love hearing that from different people that we've had on the podcast. My mantra is that all patients are created equal, all payers are not. And that medical groups really need to be aware of that. And as you say, as demographics shift over time, that suddenly you might find yourself in an area that has an increasing percentage of Medicaid patients or Medicare patients if you have a sort of an aging zip code, and that really has massive impact on reimbursement. And as we go through the physician leadership project, we run into a lot of physicians mid-career that don't really understand financially how different a commercial patient is from a Medicare patient or a Medicaid patient. And so getting some clarity around that, and again, understanding that, not all payers are not created equal and they don't treat your practice equally. So that same unit of service that you're delivering has a very different value depending on
Mhm.
what says on that patient's insurance card. And to stay vital financially and to stay viable, even, you have to be managing that. And I think a lot of groups, it sort of happens by happenstance at the front office, or just whoever calls, we'll just put them in. So yeah, that's something I think comes as a surprise sometimes to physicians because we don't teach this stuff in medical schools. So
Right.
they really have no opportunity to learn it other than, the school of hard knocks. So we try to
And
avoid.
so also with the diversifying revenue streams, I'm also thinking about, how you contract. If it's fee for service,
Mhm.
I know we're going to talk about value-based care in a little
Yeah, let's
bit,
go.
but
Let's talk about value-based.
we're seeing the growth in that area
Yeah.
also. So are you working with your IPA? Are you working with others in the market to ensure you have got the market share, the ability to contract with
Mhm.
payers rather than being straight fee for service? We've been told for a long time that fee-for-service wasn't going to be the way of the future. It's still here,
Yeah.
but there are other models out there. There's other ways to revenue share. It's difficult as a small practice to be able to stay on the upside of that, but there's certainly other ways to diversify your revenue stream as you look at different models that are in your community.
Yeah. Well, let's go there. Let's talk about value-based care. What are you seeing in the market there?
Yeah. So from my perspective, again, really focusing on the financial side, I quickly wrote the definition because I think there's so many different versions of what is value-based care. So I had a very simple: improving patient outcomes and quality of care while controlling or reducing costs. Ultimately, I see that as really paying for outcomes versus paying for procedures,
Yep.
right?
Yep.
And that's easier said than done, but that's really how I see it. I think I just heard on a podcast a week or two ago about hospitals where their value-based care models have gone from about 7% to 14%
Wow. Okay.
value-based in less than 10 years. I want to say 7 or 8 years is what they
That's
said,
a
which seems
significant
pretty
shift.
modest still, but it's
Yeah.
still a significant change
Yeah.
of what was there before.
Yeah, that's great. It's great to know. And I think for groups contemplating either, getting started, or if you're started, maybe leaning in a little more to the value-based care, we've seen some good shifts with our clients in that too, to just, as you say, diversify your revenue streams a bit. And have some things. And we have in this market, I know, and chatting with folks in other markets, we have some other kind of modified, with the primary care or the patient-centered primary care medical home. Then there's some modified payments within those systems, as well as the Medicare Advantage, which we've talked about a bit on previous podcasts in terms of that, indicates, or that requires that the physicians are doing the HCC coding to get the patient's risk adjustment factor scores up. And there's a lot to it, and there's also a lot of opportunity for groups that want to lean in. And we're starting to see more and more of the medium and smaller size groups that are becoming successful with that. I think, Tony, the larger groups that you and I tend to work with, that's part of their fabric, and they've been into the value-based care for a long time. But we're really seeing
I was going to say that.
Stretch. Yeah, we're seeing it stretch into the mid-size market now too, which is wonderful. So I hope that we see more of that, because I think you and I would both tell all of our clients, yes, please diversify your revenue streams. That's
exactly.
A healthier business. That's fantastic. I want to shift gears a little bit, because you spend some of your time working with health plans too. And the folks in the medical group might continue, consider them kind of Darth Vader. But I think there's nice ways to create partnerships between medical groups and health plans. And I wonder if you can reflect on that a little bit. Like, what have you seeing, how medical groups and health plans might collaborate?
Yeah, I think ultimately there's the dialogue that needs to occur with the health plan. What I see successful groups doing is there is some sort of channel, there's some sort of dialogue that's going on with that plan. They're a decent payer with the medical group, and it's really aligning the incentives and the goals. We've seen some variations of this, but it feels, what I've seen is really the ones that have the most communication, the most commonality as to what they're trying to do with that patient group. Also ensuring that there is a mechanism for those patients to say, yes, they can come to this clinic location, they will be served. We will ensure that they have access and they have the ability to see a provider. I think when you can provide that, that's been very successful with a number of the groups I work with, where they can contract, in one case, they've got a medical clinic exclusively for that contract to see those patients. And there's been some sharing of costs and expenses, and it's been very successful. Again, that's obviously that's a little bit more based on the volume that you can produce, the number that you can see, but you can do variations of that. And we're seeing more interest in that. In Oregon, over this last spring, we've seen more regulatory increases related to the corporate practice in medicine and what's happening with some of these provider or these insurers or insurer-related organizations. So there could be some continued challenges related to that, but I don't think it's going away. I think you're going to have to continue to find ways to work with the insurers to find value. ultimately they want you to stay in business. It's just a matter of finding a way to work together to ensure that you are really optimizing the revenue in seeing the patients within that insurance company.
Yeah, that's a fantastic insight. Thank you. I agree with you that we need to step back from this sort of, Darth Vader, very polarized relationship and get a little more cozy and potentially maybe just maybe cozy is the wrong word. Maybe a little more collaborative.
I'm back to my trust but verify,
Yeah,
right?
yeah,
So there's that step you can take, but you still want to ensure that
yeah.
everything is working the way it should, and that there is clear, again, I'm going back to my financial background, which is I want a scorecard. I want to know where
Hmm.
are we at. I want the data
Yeah,
to be very transparent from the
yeah,
insurer to the practice on how we're doing. I don't want year-end surprises that all of a sudden there's these additional costs
yeah.
that's being saddled into my contract that I wasn't aware of. So you want that openness, that transparency, so I know and I can act and make
Mhm.
changes if I need to how I'm serving those patients.
Yeah, yeah. Well, I love that. I love that you've just said trust but verify twice now. President Reagan. I mean, I give him credit. He was
That's right.
well. The thinking about the corporate practice of medicine. I'm glad you brought that up. I think last week. The Oregon legislature managed to pass what's probably now the nation's most stringent bill restricting the corporate practice of medicine in the state of Oregon. And my guess is we'll see some other states follow. I think currently there are 18 or 19 other states that have legislation around that. But that brings up the question about all of the private equity money and the mergers and acquisitions that are coming in and sort of shaping the landscape. And I'm curious to get your perspective on that.
Yeah, that's a loaded question from my
I like a
perspective.
good loaded question,
I
Tony. Come
know
on.
that in all transparency, the number of medical groups we've worked with the last 20 or so years in my career,
Hmm.
the landscape has changed.
Yeah. Yeah.
We've seen a number of the larger practices get acquired by not maybe private equity, but certainly through the insurance model. Right? I'd say 15 years ago, hospitals were buying up medical groups.
Yep.
We saw a lot of that. And then probably 10 years ago to 5 years ago, we saw more insurers
Yeah.
really buying the practices. And I would say more recently, it's really continued to be the insurer space of
Yeah.
being interested in medical groups, hospitals. Either they bought what they wanted early on, or at this point, they're having thin margins themselves. So
Yeah.
they're
Yeah.
struggling. And there's always been this story about, can hospitals manage medical groups? A lot of times there's two different focuses
Yeah.
between both of those industries, both lines of services that are
Mhm.
provided to patients. And the third piece that you just mentioned is private equity. Seeing a lot of that with single specialty groups. Basically private equity comes in, they've designated certain single specialty groups as being very lucrative and the ability to essentially profit from that. They'll come in and infuse a whole bunch of capital and allow those providers to continue to provide services. But now you've got an additional owner, if you will, who's going to get some of that extra income. The hope is that expenses can be cut and that the patient, the insurance, still gets the same level of benefit and procedure. It's just now that there's this additional owner that's involved. But I'm seeing that, I'd say a few years ago, I don't know why, during the pandemic, I saw a lot of growth in the private equity acquisitions, especially with single specialty groups, a lot of interest. We hear that in different sectors of healthcare where private equity has been very interested in. There's some where I feel like they got in early and now they're kind of stepping back and saying, yeah, this isn't really what we thought it would be.
Yeah.
And I always say, whether it's a lot of dental practices that have been bought out or physician practices, it's not as simple as going to a retail outlet
Right.
and thinking, oh, I'm going to own this store and this is what I'm going to do. It's just not the same world. I said this to a private equity buyer when they bought some dental practices, and they said, well, this is just like retail to us. And I said, it's not going to feel like
Yeah.
retail at the end of this process.
Yeah.
And it wasn't. They got out because
Yeah.
it is not retail.
Yeah.
Same thing with physician practices. But there is, I'll start, the benefits is really consolidation and scale, bringing things together, reducing some expenses. There's
Yeah.
a lot of those new compliance requirements that you have to fulfill. Now you'll have a better structure to fulfill those services,
Mm-hmm.
to do that in the background versus having one group that's got to incur all the costs related to your electronic health records, related to that quality procedures,
Yep.
oversight that you have to do, compliance. You now have an extra organization essentially that can come in, provide those services in addition to what they do for other practices, and hopefully get some economies of scale in the
Yeah.
process. Infusing capital and investing in the practice, a lot of times that's also a benefit of private equity. So seeing that
Yeah.
has been a huge benefit. And the other thing I'd written down was just the professionalization, if that's a word, of operations is really having a very more structured approach to how you are operating, how you're managing your expenses. As you can guess, what we've seen with some practices, there might be, like, let's say orthopedic practice, you might have one orthopedic surgeon that prefers one type of implants, then you have another doctor that prefers another. You now have all this inventory for all these different manufacturers, and that increases the cost to the organization. So you think about that, and when you have something like private equity, a lot of times those get streamlined into what is truly, the best in class, and what do we want versus having all these different preferred manufacturers of inventory. So again, to me, I see those as benefits. I think the downside has been discussed enough as to what folks see when it comes to private equity coming in, because you get the really good, and then you also get some things, which is, yes, you now have another owner. You have somebody else who gets to voice their opinion on what they would like to see. And the physicians may lose some of that autonomy and some of that ability to be able to drive the growth, the structure, the direction of the organization.
Wow. There's definitely give and take. And thank you for shining a light on some of the more positive things. I think, again, we have a tendency to vilify the PE and the big payers that are coming in and buying, these medical practices. And in reality, there's some positive things that they do. So,
and we've talked.
Go ahead.
Go ahead. I was going to say, we've talked before about the different generations and what different physicians that are coming into the practice might want. And we've heard, in some cases, you might have some younger physicians that might want a different model than what they've had, what older physicians are used to, which is more of the autonomy and the ability to really drive where the direction of their group is. And you have a mix of that. I would say it's not quite as cut and dry. It's more of a mix where you have some folks that certainly are more willing to be on the bus, if you will, and some that want to drive the bus.
Yeah.
And so you have to somehow balance that out with what the needs are of your group.
Yeah. Thank you for that. Again, I appreciate the balanced perspective. It's easy to rattle off all the bad things that happen when, PE comes to town or the payers come to town buying medical practice.
And I can do that if you want an alternative version to this.
Alternative ending to the podcast. Yeah. Maybe we'll have a different podcast on that one.
Yeah, there you go.
Yeah, the good, the bad, and the ugly.
The
we
dark
can call
side.
it. Oh, that's so great. Well, I've loved this whole entire conversation. You and I could talk for days. I know that. I'd love to wrap it up by asking you if you could give one piece of advice to a CFO or an administrator at a growing medical group. What would it be?
Again, this will be boring, but from a financial perspective, it is cash flow. It's not being surprised at the end of the year that you want to grow and you don't have the cash to do it. It requires a lot of different considerations, but it sounds simple, but it's managing the cash flow that the organization needs to continue to grow. A lot of problems that I see with the smaller groups, especially, is they paid the providers, they paid the physicians out at the end of the year. There is no cash remaining in the organization. So if you want to grow, if you wanted to add a location, if you wanted to add some equipment, you don't have the cash to do it. So you're going to have to borrow, and you may not have the ability to borrow if there's just not enough assets within the group. So what do? I generally say, have that cash on hand, at least establish how much cash you think you need and what your priorities are for the next year or 2 years. Hopefully you've got kind of a longer vision of what you need to invest in, and making sure you have that cash set aside for those purposes. One of the downsides to that is, in an organization that doesn't pay out all its excess cash, generally you will be taxed on that.
Yeah.
I would tell you most of our clients don't like to be taxed, but I'll call it a necessary evil, because if you want to keep reserves in your company, you're going to have to pay some tax.
Yeah.
So
Yeah.
it's a price of doing business, essentially.
Yeah.
With the pandemic from 5 years ago and the huge cash crunch that we saw a number of clients go through,
Yeah.
some had such little cash to begin with because of how they did operate, that they had no excess cash once services had to stop or
Yep.
be reduced dramatically. Cash wasn't coming in the door. It created a huge impact. And it really wasn't until some of those provider relief funds and some of those Medicare advance payments were received that really helped the cash flow situation. I would say don't rely on the government.
Right.
We don't know what is going to happen in the
Yeah.
future when it comes to funding, grant funding, or reimbursement. So ensure you have that cash on hand for those, what I call rainy day funds, when something happens, or more proactively to invest in the future of your organization and what you'd like to do.
Yeah. Wonderful insight, Tony, as ever. Thank you. I so appreciate you and your expertise and your willingness to come on and share that with our audience today. So thank you so much.
Thank you so much, Jill. As always, it's always a great pleasure to talk to you and get to talk to your listeners.
Thank you.
Thanks for tuning in to today's episode of the Medical Money Matters podcast. Before you go, let me ask you, are you ready to take your medical group's coding to the next level? Because that's where Code Mastery comes in. Code Mastery isn't just another coding program. It's the ultimate physician-to-physician training solution to maximize your revenue and empower your physicians with the skills they need to code confidently and win the coding game. From comprehensive high-octane training to actionable insights, Code Mastery gives you the edge you've been looking for. Don't leave money on the table. Visit healtheps.com/code mastery to learn more and take control of your coding today. Let's transform your practice's financial future starting now. See you next time on the Medical Money Matters podcast.